So this was the last slide, right? So the quiz will be on this one. We didn't talk about this, so let's consider this one. So now SNL actually stands for S means small, L means large, because it's only 10,000. It's 10 times as big as 100,000 investment. And CF1, 16,500. This one, 116,000. If you calculate IRR, it's 65%. This is only 16%. But if you calculate NPV, 5,000. This is 5,455. So given your current knowledge, which project would you choose? Be brave.
Is it L because the NPV is bigger?
Check. So far, that's the answer, right? Even though IRR is big, the dollar amount is only 5,455. But as I said, NPV rule is the best when everything is perfect, right? All your forecast is correct, your cash flow calculation is correct, your cost of capital is correct, and you have unlimited supply of money, all those things, then NPV is the best. But real life is not like that. Like people are subject to errors, right? So when we have, let's say, 10% forecast error, let's say, then this risk is always what? Downside, right? Downside is the problem, right? Upside is fine, right? Making more money is good, but risk means downside is problem. So 10% forecast error, the upside is okay, but downside, 10% of 16,500 is what? 1,650. So you subtract down 10% error, then what? Cash flow is still 14,850. IRR still huge, NPV big. But for project L, just 10% forecast error, so 116,000. 10% of that is 11,600. Subtract that from 116,000, you have 104,400. That is what? This is like lower possibility, 10% error. Look at this IRR, only 4.4. NPV is huge negative. So let me ask you one more time. So if you are a kind of reasonable manager, which project would you choose?
S.
Check, right? Because, you know, people are subject to errors. So in this case, just 10% error, you have huge net present value and huge negative net present value. So you probably hesitate, right? That's what we call safety margin. So L has really low margin, but S has huge safety margin, right? Even 20% error, you have high IRR and NPV. So S is pretty, you know, kind of, in some sense, safe to choose. L, it can be very risky. So in that case, rather than going for NPV, you may go for IRR, right? And you may consider safety margin. So that's why here we say, that's why we have to consider all rules, because each rule provides a different piece of information. Because of time, we did this one first, right? NPV rule is the best. So it gives a direct measure of dollar benefit. Shareholder wealth maximization consistent with, and payback period can be used as a measure of liquidity and risk. IRR can be more useful when safety margin is concerned. IRR and MIR may be better when capital rationing exists, right? I told you that. If money is the problem, then you may want to just go for IRR. So that's conclusion. That's why net present value is the best, why we should consider other methods, right? So that's the last class. And then more advanced stuff is like this. We talked about the marginal cost of capital in chapter 11. Yeah. Then what? Then we have to consider cost of capital increase as you raise more capital, right? So externally raised capital can have a large flotation cost, which increase the cost of capital, right? For equity case, okay, flotation cost. And also investors often perceive large capital budget as being risky. Risky means what? Higher cost of capital. So, you know, like when you consider like increase in cost of capital by just having more budget, okay, then what? Then we have to consider marginal cost of capital and profitability of project to decide the optimal capital budget. So if external funds will be raised, then net present value of project should be estimated using higher marginal cost of capital, okay? So that is, you know, important because the bigger amount of capital means what? Bigger risk means higher cost of capital. So given that just fundamental concept, we can now just solve practical questions. Optimal capital budget. So we have two things here, chapter 11 and chapter 12 combined. So first, MCC schedule from chapter 11. So let's say this one is already calculated. From 0 to 10,000, 12.86%. From 10,001 to 20,000, 13.16%. From 20,001 to 25,000, 13.9%. From 25,001 to 30,000, 14%. And 30,001 and above, 14.54%. So that is, you know, cost of capital increase by borrowing more, by using more money. Then next one is investment opportunity schedule, IOS. So this one is projects and their cost and their return. Then what? Project A has $5,000 cost, B 5,000, and called IRR 17%, C 5,000, 14.2, 10,000, 13.7, 10,006. So given these two tables, the question is, what is the optimal capital budget? Okay, the question, the optimal capital budget. Then you have to use both table to draw MCC schedule and IOS together. The first thing is you have to draw MC schedule according to chapter 11. We did that, right? So from 0 to 10,000, 10K.
Professor,
So that, yeah.
could you go back one slide real quick?
Go back one slide. This one?
Yes, please. I just missed one number. Sorry about that.
No problem. So not this one. We have this one. So.
You're good. Thank you.
Oh, thank you. So this one. So So according to the table, so this is a review, MCC schedule from 0 to 10, MCC1, cost of capital is 12.86%. And 10K to 20K, we have 13.16. So this one like this, MCC2, 13.16%. Now from 20K to 25, about half, 25K. Then MCC3, 13.90. 13.90. Then from 25 to 30, 14%. MCC4. And 30,001 and above, MCC5. That is 14.54. And this one, MCC4, is 14%. Like this, right? So this is a review. First, MCC schedule. Then next is what? Important thing is make sure that you draw IOS that based on profitability. So you draw the highest profitable project, that is B, right? That is B. So that is, let's use a different color, let's say. That is, and you have to know also the size. That is project B, 5,000, 17%. So 5,000 is half of this. And you have project B, 17%. Then next highest is project E, right? But that is 10,000. So there's 5,000 to 15,000 like this. So that is from here to here. E, 16%. And next highest is 14.2, right? That is project C, 14.2. So project C is 5,000. So from 15K to 20K, that is 14.2 is around here. So that is project C. And next one is 13.7, project D. So project D is 10,000. So that is 13.7. Around here, right? Around here. So from here, 2230, 2230. Oh, is slightly, is even below this one, because it's 13.7, below 13.9, so it's here. So that is D. So that is below 13.9. This one 13.7. 13.7. And last one is 12%, 5,000. So 32, but that is 5,000, so 32, 35. So only 12%. That is 8. That is 12%. So if you draw this, so this is MCC schedule. And this is iOS investment opportunity schedule. When I draw this, what do you think? Or which project would you choose? Be bold.
MCC?
You said BC? Is that correct? What did you say? One more time.
No, iOS.
No, iOS is just name of this graph, investment opportunity schedule. So my question is, which project would you choose? Which projects? Plural. Which project? Huh?
Project D.
Project B? But is that all? Be bold. Wrong answer is better than no answer.
What does this all mean?
Huh? What is what?
Yeah, like what does this graph demonstrate?
Yeah, the iOS investment opportunity schedule show you the project and their size and their return, right? MCC schedule is marginal cost of capital that is increasing through what how much money you, so x-axis is dollar sign and y-axis is percentage, right? So when you look at this graph, what's your conclusion? Which project would you choose?
B, I guess.
E.
B is correct. And what else?
Option C.
C. Good. What else?
E.
E. Check. Because
Next.
all B and E and C are all above cost of capital, right? But look at D. This D is below MCC3 and MCC4. So this is less than its cost. And A is for sure. Well, so actually, as you know, you choose B, E, and C, right? So those are your choice, B, E, and C. And then, so according to this one, conclusion is choose B, E, and C, and the optimal capital budget is how much?
$20,000.
Check. Good answer. Because as you know here, B plus E plus C is what? B plus E plus C. Oops, what's going on? Let's go back. Good. So this one below C, you see what? 20,000. So B is 5,000, E is 10,000, C is 5,000. So 5 plus 10 plus 5 is 20. So this is optimal capital budget. Is 20K. In other words, you don't have to choose DNA. If you choose DNA, then what? The budget will be bigger, right? But that clearly shows you that bigger budget is not always better, okay? So bigger is not always better. Your profitability goes down if you choose DNA. Then you may ask, if I put D first, right, then what? That is above, D is 13.7, so that is above MCC1 and MCC2. So you will choose D, right? Why you put B first, you may ask, right? That sounds like that makes sense, right? So let's check. New slide. And now we are using, to save time, MCC1, 10K. MCC2, also 10K. And MCC3, only 5K. 25K. MCC4 is also 5K. 30. MCC5, it's like this. This is MCC schedule. But as you said, this is 12.86. Project A is even below this one, so A is gone. But D is 13.7. So 13.7 is what? A lot higher than this one. So 13.7. And D is 10,000, so you can draw like this, 30.D, right? So you just, how about lower return and going up? And D, and next one will be 14.2. And that is what? 5,000 C, so 15K. That is C. C is like this. And the next highest is like 10,000, 16% E. So 10,000, 15 to 20, 25 E. So C is 14.2%. E is 16%. And finally, B is 17%, 5,000. So 30,000 like this. Then what? Then you can take 4 projects. They are all above the cost of capital, right? So your optimal, then your optimal capital budget can be 30,000. And that sounds correct, but the answer is no, right? The reason why you have to draw like this. Highest return project first and then go down is that by doing that, you can have optimal capital budget. If you draw from low capital, low return project, you can take more project, right? DCEB, and your optimal capital budget increase to 30,000. But the profit is what? Profit is like this. Return minus cost. So B, so let's use, let's say green. Green. So profit is like this. B minus 17% minus 12.86%, right? So it's like this. Like this. So this area is profit, return minus cost, right? Same thing happens here. So D minus MCC1 and C minus MCC2 and E is like this. So this is profit, right? So simply return minus cost. Then the total profit is like this. Total profit is, from this one, so let's use one more slide. Then profit for 20,000 budget. That one, this one, 20,000 budget. Then what? Then is what? B 17% minus 12.86, right? 17% minus 12.86. So 17 minus 12.86 times this one, 5K. And then let's just skip K's as 5, okay? So this part is 17 minus 12.86, that is times 5, plus, second is what? E is 16%, but MCC is from 5 to 10. So this area is 16 minus 12.86. 16 minus 12.86 times 5,000. So this is 5,000, this is 5,000. And then E, 16%, but now the cost is MCC2. MCC2 is 13.16, right? 13.16. So E is 16 minus 13.16. So plus 16 minus 13.06. 13.06. Oh, 13.16. Sorry. Times, this is what, 5,000, right? 10,000 to 15,000, so times 5 plus.
Wait, isn't C 14.2, not 16?
No, we are doing still E. E is 10,000, so 5,000 is 16 minus 12.86, and another 5,000 is 16 minus 30.16 MCC2, right? So project E is divided by 2, right? 5,000 is over MCC1, and 5,000 is over MCC2. So this area. So 16 minus 13.16 times 5. So 16.13. So that is E. And finally, C is what? C is 14.2%. C is 14.2. So 14.2 minus, again, same thing, 30.16, okay? This area. So 14.2 minus 30.16 times 5, right? And then that's the total profit. The next, for this one, when you start from low return project, we need to calculate total profit. That is this one. D is 13.7% minus 12.86%. So that is this area. 13.7 minus 12.86. 13.7 minus 12.86 times 10, because the basis is 0 to 10, 10. And C is what? C is 14.2 minus second is what? 30.1. 14.2 plus 14.2 minus 13.16 times 5. Why? Because only from 10 to 15. And E is 10,000 project. So this E also has two just area. That is 16 minus 30.16, this area, plus 16 minus 13.16 times 5, plus this one, 16 minus MCC3. MCC3 is what? 13.9%. 13.9%. So 16 minus 13.9 times 5, plus finally this one, B17 minus this one is MCC4, right? This one. So that is 17 minus MCC4 is 14% times 0.5. So this area, profit for 20,000 budget is this, only 4 areas, but this area is bigger than, this is profit for 30K budget. So just please calculate, this is not difficult, right? Calculate the area at home and compare, then what? Then definitely this area is bigger than this area. So now we know that. That's why you have to start from the highest project first and go down, right? And optimal capital budget is 20K. Even though it's small, profit, total profit will be higher, right?
Professor?
Yep.
So just to clarify, I'm trying to figure out, so the reason you did the 30K was to show us that the 30K profit is going to be lower if your operating capital budget is 30,000, your profit will still be lower than 20,000, right?
Sure. So that's why 30,000 is not optimal, even though that's bigger, right? But 20,000 is the optimal capital budget. You take B, E, and C, optimal capital budget is 20,000. But
Thank
if
you.
you do this way, you take DCEB 4 projects. So optimal, so budget will be 30K, right? 30K, but that's not optimal. Bigger is not always better. So that shows you that when you make a decision, you have to draw from the highest profit project first and go down. So then what? And please check this one. Please check this too at home. Okay.
Professor, I have the numbers if you want them.
What is this?
The first one should be 0.558.
0.558. You did 17. You said 17. You said you did it 0.17, right?
Yeah. Well, it should
Second
be
one. Second one.
0.558. The first one is 558.
Isn't it a cost?
Not point.
percentage?
No point. Just 558.
No, I mean, you put 885.
885. Sorry. So 558. Sorry. 0.558.
Yes, yes.
0.558. Okay.
And
Second one.
the second one is 0.638.
Then this is bigger, right? It's a mistake then.
Yeah, wait.
Are you sure?
Mm,
Then this is better, right? So something's wrong. Since you said, let's check. 17 minus 12.86 equals what? 4.04 times 5 equals. So let's store that at 1. 16 minus 12.86 equals 3.14 times 5 equals. Store that at 2. 16 minus 13.16 equal 2.84 times 5 and store that at 3. Finally, 14.2 minus 13.16 times 5 and store that at 4 and plus recall 1 plus recall 2 plus recall 3. 14.2. This is 14.2. According to this one. 14.2. Let's
You
go
didn't
to this one.
You didn't press
Yeah,
the
never mind.
It should be 55.8.
Huh? Which one?
Press
You
E
didn't
on
press
your
the equals
calculator.
sign.
Let me check. So recall one, so start from beginning. Recall 1 plus recall 2 plus recall 3 plus recall 4. Oh, 55.8. Oh, thank you. So 55.8, that's correct, right? So 55.8. Because you did so this one times 100 because you 0.17 minus. So this one, then this number may be wrong. Let's check. 13.7 minus 12.86 equals times 10. So store, let's say store 7. Then 14.2 minus 13.16 times 5, store at 8, and 16 minus 13.16 times 5, 14.2, stored at 9, and 16 minus 13.9 times 5 equals stored at 6. Finally, 15. This is 15, right? So 15 stored at 5. Then starting from recall 7 plus recall 8 plus recall 9 plus recall 6 plus recall 5. 53.30.
Yeah, I recalculated right now. And I messed up the 10 and 5.
Some here, right? So there's 53.30, and this is 55.8. So definitely it is a lot bigger than 50. So the difference is what? 50.8 minus 53.3, 5, 2.5. It can be $2.5 million or $2.5 billion, whatever. So now this one definitely shows you that, but thank you for, that's a big participation. Yeah, I like that. Yeah, you have to follow me and calculate. And it's extremely important that you follow me with your calculator, because some people didn't follow me and didn't know their calculator was set wrongfully. If you don't practice, then you don't know whether your calculator is correct or not. Then your grade may be just very low, right? If your calculator is set wrongfully. The reason is what? The reason is you didn't practice. So you thought that the calculator is correct. Until you can't know that until you practice, right? So you have to, so that's a really good practice. Yeah, Hector is really good. So that's something that model behavior. Okay. Just check all the numbers. It won't take much time, right? So make sure that, you do that in class. You have your calculator handy, right? So just follow me using your calculator and check whether your calculator number is same with mine, right? Then what? Then you are just practicing. Even in class, you practice. And after class, you practice again. Then what? Yeah, you can get good grades. Just practice. Any other question?
Is that the cost? Is that supposed to be 55,800 or is it supposed to be 558,000?
It's like this, as you know, this is actually, I did it my goal was just show you the number. So this number bigger, but Hector's way is better, because what? That means that a 5,000 times percentage. So this is 0.558 is in that sense is better. So 0.588 thousand times 1,000 is what? Then what? 558, like 1,000.
Yeah, that's what I got, because I made all the percentages into decimal form.
Yeah, that's correct. Yeah, you multiply 5,000, right? Then you get this one. Yeah, that is total profit in dollars, total profit. But my goal was not showing the total profit in dollars. My goal was trying to show you the size, right? Size. So this number is bigger than this number. That was my goal. So, but thank you for pointing that out. Yeah, that is just dollar times return. That is your profit. So this is total profit, 558. Yeah. And then this one is 533. So like $25 difference. Yeah. Good point. Any other question or comments? So that's the end of chapter 12, but I didn't do much today. So, and you study hard for the exam. So chapter 12 homework, we can skip that because you already studied. Okay? Homework is there for you to study. And today we cover only several slides. So you don't have to, but you can just practice your homework yourself, but you don't have to turn it. Yep. Okay, so now we cover chapter 13. Chapter 13 is very important because it's more than just capital budgeting. We are considering now risk, okay, how to take the risk of the project into account, because chapter 12 is basically, we consider projects with basically the same risk class. So that is just not real life. In real life, the project's risks can be all different. So we have to consider for more advanced stuff. So let's examine first. By the way, today's quiz will start at 4:30. So we have still plenty of time, 4:30. So please let me know at 4:29 if you remember. So page 553, we have a project that is project 13.6. So let me read you. The Campbell Company is considering adding a robotic paint sprayer to its production line. The
Professor?
sprayers, yep.
I'm sorry, I have a question about chapter 12. I just had to get my mic working. Is there any way to tell what combination of projects will have a higher profit just by looking at the graph, or do we have to do the profit calculation for every combination of projects?
That's a good point. Here, I showed you this profit to show you that the correct way of solving this problem is putting highest project first and next highest, rather than lowest project first. So if you do this way, lowest project, then your capital budget may be higher, but what? That's not optimal. So for you to get optimal capital budget, you have to do this way. So actually, I won't give you problem to solve this profit, right? This is not the point. Point is to show you that this way is wrong. I just verify, right? So if this is on the exam, don't do this way, but what? Do this way and just select project based on highest projects and choose optimal capital budget. That is what, that depends on how many projects you choose, right? So optimal capital budget is adding all the projects in their sizes, right? According to their sizes, right? So project B is 5,000, project E is 10,000, project C, 5,000. So 5,000 plus 10,000 plus 5,000, 20K, yeah. So that's all you need to remember, right?
Okay, that makes sense.
You don't have to do that. This is just for me to explain. Okay.
Thank you.
Yeah. Thank you for asking. Yeah. So let's just read again. So the sprayer's base price is 1,080,000, and it would cost another 22,500 to install it. So installation. The machine falls into the maker's 3-year class, and it will be sold after 3 years for 605,000. the machine would require an increase in net working capital, such as inventory of 15,500. The sprayer would not change revenues, but it is expected to save the firm 380,000 per year in before tax operating costs, mainly labor. Campbell's marginal tax rate is 35%. So in this case, should you choose the project or should you reject the project? That's the question. So important numbers are summarized here, right? So total depreciable cost is not just equipment cost, but you have to add installation cost, and if there has been shipping and handling, you have the shipping and handling and modification. Oh, those all, if you incurred all those costs, you have to add them. Common mistake in the exam is that they have depreciable cost is just equipment. That's wrong, right? The first mistake is that just equipment is depreciable cost. That's wrong. You have to include installation. And changes in working capital, because inventories will rise by 15,500. That is, something, you need some kind of assumption about that, okay? I'll talk about that later. And finally, effect on operations, saving 380,000 per year. What is this? Saving 803,000 per year. Is it cash flow? Saving 380,000 per year.
The question said that it was on cost of labor primarily was what they were saving that on.
So is that cash flow or not? My question is.
No.
Why? Why no?
Yeah, because that's what I think, Professor. That's something that you save that could earn you some more money. That's what I think. It's not included in the cash flow.
Wrong answer is better than no answer. Big participation, but wrong answer. For finance guys, saving is same as revenue. You have to think about that. Saving is same as revenue. You have to really make sure that, from now on, saving is same as, revenue. It's like this. Let's say if a revenue $20 million, right? But you have to spend $10 million, then what? Then net, this is your company's fault, save. Then net is 10 million, right? But your revenue is 20 million, but you save 10 million. So in other words, you don't spend 10 million, then what? You have 20 million, right? So actually cash flow is what? 10 million more. By saving money, you are gaining $10 million. So saving is exactly same as making money, right? So it's like this. Then for you to have so A and B, for you to have A same as B, then what? Then if you make $10 million, let's say, then what? Then now you have from here to 20 million, right? So saving 10 million is actually in finance exactly same as making $10 million, right? So now before you make 20 million and spend 10 million. And also, if you make another 10 million, then what? Total is 20 million, right? Then what? Your cash flow is 20 million. But like this, even though you don't make any money, if you save 10 million, then what? You get 20 million. So saving is actually same as making money. So saving, so let's use saving 10 million is making 10 million, right? So saving 10 million is making 10 million. So don't forget that. In finance, saving money is exactly same as making money. But people's perception is that they like making money more than saving money. The saving money is not really visible sometimes, right? Not striking, whatever, right? Making money is like anybody knows that and very happy, but saving money, you may not see that, but that is in finance exactly same as making money. So finance guys has to be cool, okay? What is the cash flow? You can increase your cash flow by making more money or saving more money. That's why when takeover happens, the acquiring company fire people, saving money, right? So they may turn company around because it's hard to fire people when you know people. They can do that, but still it's easier for firing people if you don't know people, right? Acquiring company, they just cut costs and turn company around. So saving is extremely important. So don't forget. So common perception is saving is not cash flow, but that's wrong. Saving is exactly same as revenue in finance. So saving 380,000 per year means what? You are the same, exactly same as making 300,000 per year. So that's very important. And then what? Then the remaining facts are life of the project 3 years, and depreciable basis, depreciable life is the depreciation is using Makers 3-year class. How many of you remember Makers? Anybody? Oh, several people. Okay, not many. Exactly. Somebody said a penny saved is a penny earned. Yeah, that's correct. Okay. So here we have to, so many people forgot about Makers. Makers is what? Makers is M means modified. A means cost. Cost. No, A is not called, A is accelerated. Modified, accelerated. C means cost. R means recovery. And S means system. So Makers is from Acres. Before Makers, there was Acres. Accelerated cost recovery. Then so accelerated cost recovery means what? You deduct more money in the beginning, okay? In the beginning, okay? Deducting more money in the beginning. So let me just show you one more slide. So let's just think about very simple case. If you use straight line depreciation method, then what? Let's say if you operate 2 years and you invest $1,000, let's say $1,000 is depreciable basis. And each year you get $1,000 revenue or net revenue. Then what? Then you subtract, straight line is what? 2 years, so 1,000 divided by 2. So 500 depreciation per year. Then 500 taxable income. Then tax, let's say 40% tax, let's say. Then what? 200. Then what? You have 300 is net income. But you have to, from 3 or 4, depreciation add back. So this is depreciation. Depreciation add back. Then 500. Then 800 is net cash flow. So this is like straight line depreciation. Then makers means what? Makers are accelerated depreciation means what? You depreciate more in the beginning. So let's say minus 1,000 is the same, right? Now depreciation is just depreciation is what? Let's say more. So let's just one example. Let's say 600 and 400, right? Total depreciation should be 1,000, right? So 600 and 400. Then what? Then taxable income is 400, 600. And tax is 40%, 160. And 240. 240, 260, this net income. And depreciation add back, 600, and this is 400. Then net cash flow, 840, this is 760. So cash flow is the straight line method, 800, 800. But accelerate method, 840, 760. If you add them up, both are 1,600, right? Are you indifferent? Be bold. Wrong answer is better than no answer.
Your question was, are you indifferent?
Yeah.
No.
Why?
Well, your net cash flow is different between period 1 and period 2. Well, your net cash flow between the first option and straight line and makers is different. So you would pick which one is better.
But my question is 800 plus 800 is 1,600. 840 plus 760 is still 600. Why you are indifferent? So you are indifferent?
So time level value of money, Professor.
Check. Correct.
Yeah, you could get rid of it.
Yeah. The reason is you like this one better. This one is B, A and B. You like B better because time value of money. The sooner you make bigger money, you can invest this one and make more money, right? Or even present value wise, this one has bigger present value. So either present value wise or future value wise, B is better. So you make more money, right? Then, so businessman like, or businesswoman like B, right? Then who doesn't like B?
Government.
Check. Good answer. Because government, they have a smaller tax. Look at this. This one, tax was 200, right? But look at this, tax is 160, the time value of money. So smaller tax. So government is not satisfied. So they don't like accelerate depreciation. So that's why now tax law, they originally it was acres, as I said, but now M is there, modified. So they changed the rate just slightly less. So that is makers. So makers is simply very simple. Depreciable base is times depreciation rate set by the tax law. So, and the sale price is 605,000, tax rate 35. So those are remaining just information. And this one, if you don't understand this one, then what? Then you forgot 3 or 4. So that's why I went by fast. But basically, this one says that this is tax season. Tax season, right? Your deduction, the more deduction means what? The less tax. So you pay smaller tax. So you like higher deductions, right? Same thing. Depreciation is deduction. So if you deduct more, then you pay smaller tax like this. If you deduct more, you pay smaller tax. You pay smaller tax. So you like B, right? And then what? Then depreciation, as you know, is a non-cash expense. As you know, this depreciation is determined by depreciation methodologies. So this is not cash. This is just assigned value by some depreciation methodologies. So for you to calculate cash flow, you have to add back depreciation. Okay, that's why you add back depreciation, right, to net income. Okay, that is, how to calculate cash flow, right? You add back depreciation to net income because you subtract depreciation, which is non-cash. So for you to get cash flow, you have to add back. Okay, so that's why we have depreciation add back. So plus. So next, the how to solve this problem, we have to first estimate relevant cash flows, and then calculating annual operating cash flows, and then identify changes in working capital, and calculating terminal cash flows. So terminal cash flows calculation is where many people miss. Then let me tell you the assumption, working capital, net working capital. So net working capital level assumption is such that you have like this one, net working capital level, right? Time zero is when you take the project, then what? It goes up, then what? Big change, then what? You maintain the level. And then what? And N means end of the project. Then what? It goes back to its original level. Then net working capital increase means cash flow, what? Net working capital increase means cash flow
Decreases.
Check. Why? Because net working capital means current asset minus current liabilities, right? So debt goes up means asset goes up, then what? Cash flow goes down. For example, in the problem, your net working capital increase because of inventory, right? So you need more inventory for this project than what? For you to increase inventory, you have to pay money, right? Cash outflow. So that's why cash flow will be negative. Okay? Higher net working capital means cash flow negative. And if you maintain same level, then there is no outflow or inflow. But at the end of the project, you don't need that increase in net working capital because you need that increase in net working capital because of the project, right? But the project is over, so you don't need that. Then net working capital level goes down. Goes down means what? It's like saving money, right? So then what? I told you that there is increase in cash flow. So in the beginning, cash outflow. In the end, cash inflow, right? I told you the saving is what? Cash inflow. So that's the assumption. In real life, maybe you may have to this working capital level may go up and down, right? But to make it simple, just we say that you need higher working inventory for this project. So you maintain the inventory level, and then at the end, it goes down, okay? So that's the assumption. Given that assumption, oops. Initial year net cash flow is that you find the change in net working capital. So increase in inventories, 15,500, that is negative. Look at this negative because, asset increase, cash flow decrease. And I told you that this one needs installation cost is negative. Equipment cost we have to pay is negative. So initial year net cash flow is all, don't forget this negative, all negative, because negative means what? Your investment. Okay, no free lunch in finance. You have to invest something, right? Something to generate your cash flow. So generally speaking, time zero cash flows are negative. Why? Because you have to invest. So you have to spend money. So all negative cash flows. And then maker's depreciation is pretty simple. That is what? Those depreciable rates are given by tax law. Then what? All you have to do is multiply these rates to basis, depreciable basis. So that is, basis is depreciable basis. That is, as I said, equipment cost, shipping and handling, and installation or modification. So any extra cost that make the machine running, right? That is all depreciable basis related, directly related to running the equipment. Then those ones are all included. As I said, many people forget to add all those ones and just use equipment cost as depreciable basis. That's wrong, right? Of course, if those ones are not given, then what? Then equipment cost. So in the exam, maybe shipping cost may be given, or installation cost may be given, or modification cost may be given, or some combination of given, or all of them can be given, then you just add them all. So that is depreciable basis. So here, equipment cost is 1080, right? This is 1080. And installation 22.5. So this one, installation 22.5 in thousands, right? So we have what? 1080 plus 22.5 is 1102.5. Then what? Then you multiply this rate. This is more accurate, but probably in the exam, to save your time, I'll probably give you 0.33, 0.45, 0.15, 0.07. So you don't, the point is that you don't have to write down those ones. Just I'll give you the rate. So then you have to multiply this rate in the exam. But in real life, it should be more accurate like this. And then
Professor,
what? Yep.
why is our basis is 1.102.5?
Let's go back to here. This one, yeah. Depreciable basis is equipment cost plus shipping cost, installation cost plus modification. But for this problem, there is no shipping cost 0 and modification 0. So equipment cost is 1080, right? And installation is 22.5. So 1080 plus 22.5 is 1102.5.
Okay, thank you.
Thanks for asking. Yeah, so many people probably have the same question. So that is, and of course it is just, in thousands, actually 1080. So everything is in thousands, right? So it's 22.5, that's why. So skip is in thousands. And you may ask, there's 3-year makers, how come there's 4 years? The reason is makers half-year convention. That means if you buy a machine January 1st, then what? You use it whole year. But if you buy the machine in December 31st, then you rarely use, right? So to just avoid any confusion, the tax law assumes that you buy the machine in the middle of the year. So first year is only half year. So first year is half year. And second year is full year. Third year is a full year. And fourth year is also half year. Right? So total 3 years. So that's why 3-year asset is depreciated over 4 years. Okay. So we understand that first year, and that's why this accelerated means first year may be higher than second year, but this one is low because what? Originally is 0.6666, but what? Half year, so 0.3333. That's why first year is smaller than second year, right? That's why. So, but all you have to know is just rate. Rate times basis, pretty easy. Rate times basis, okay? Each year's depreciation is like calculated like, and total is what? Total is depreciable basis. So that's the most important, just how to calculate depreciation. Basis times, don't forget that you should include all shipping and installation, whatever. And then what? And then just multiply the ratio, rate. And if this is on the exam, I'll give you the rate like this. Then how to calculate annual operating cash flows. Just look at this. It's revenues, it's savings, but it is just revenues. Okay, I told you that savings same as cash inflows, the revenues. And depreciation expense is from here, right? 367, 490, 163. So 367, 490, 160. But it says that 3-year operation, so you have to read the question carefully. 3 years. 4-year table, but you operate 3 years, then only 3 years of cash flows. And then what? And this is exactly what I did here. This one, right? Revenue minus depreciation. And then your taxable income and tax and net income, depreciation add back, right? So that is this. Then what? Then your operating, so 380 minus 367 is 125. That is operating income or taxable income. And 35% tax, so 12,537 minus 4387, the net income, this one. Then you add back depreciation. As I said, depreciation is non-cash expense, but since you subtract, you have to add back to get cash. So cash flow is like this. All the others, and look at this. This one, you have to be very careful. That is what. Depreciation is bigger than revenue, so operating income is negative. Then many people got confused. If operating income is negative, then what? Then incur loss, so you can apply this one to other projects' revenue, so you pay less tax. So actually, if you incur loss, tax is not zero, it's tax savings, right? So 110,061, right? Negative, right? Negative loss, and then many people think that is loss or tax is zero. Wrong. You have to multiply that by tax rate. 44. Oops.
It's 35%.
Oh, thank you. Check. So 110,061 times 0.35, 38,520. But this is now, look at this, positive. Why? I just said tax savings. So it's plus, not negative. When you have profit, then you have, this is negative, right? Tax is, you subtract tax. But you have a loss, then what? You get tax savings or tax refund. So it's like you have, this one is plus, and then what? 110,601 is what? Positive, negative, so minus.
So professor, so 38,521 is 35% of 110,000. Is that
Yeah, 35%. Yeah, tax 45%.
So we get the loss. So for example, like how matter our business doing, like if we have a loss, they will add more money for us. Is that what is meant?
No, it's when you have a loss like this, when you have a loss, then what? You can apply this one to other projects' revenue, then what? The taxable income goes down, right? Then you pay smaller tax. So that's why this tax saving comes in, right? So if normally your company doesn't have just one project, right? Many projects, right? So one project's loss can be applied to other projects' profit. So the profit, this one makes other projects' profit down, then what? They pay smaller tax, so tax saving. So be careful. So you have 110,061, right? It's negative. So let's store that at 1. Then what? Then this one times 0.35. But now this is positive, I just said, tax saving. So plus, we call 1. Then what? So be careful in the exam. Many people got confused. If income is negative, they don't know what to do, right? Simple. If income is negative, tax is positive, so net income is less negative, right? But if you add depreciation, then bigger operating cash flow. So this is actually step-by-step income statement way, but we can have better way that is like this. Revenue minus depreciation is what? That is revenue minus depreciation, right? Taxable income minus tax, T is tax rate, revenue minus depreciation. Make sure that we have quiz on time, like this. I have timer. Then what? Then, so this is taxable income. This is tax, T is tax rate. Then what? The net income is revenue minus depreciation minus T times revenue minus depreciation, right? The net income. And depreciation add back. Then plus depreciation, right? Then this is net cash flow. Then what? Then look at this. If you solve this one, there is what? Use this one. Minus depreciation plus depreciation cancel each other. So now you have revenue minus T times revenue, right? Minus minus is plus, plus T times depreciation. And that is revenue minus T times revenue is what? If you take revenue out, then what? Revenue out, then 1 minus T plus T times depreciation. So that is net cash flow. Simply, after tax revenue plus depreciation times T, that is net cash flow. And that is this. Operating cash flow is revenue, right? This is a revenue, times 1 minus T plus, this is depreciation, right? Depreciation times T, and that is operating cash flow. So this one, this formula will just make this income statement way kind of useless, right? It's faster, right? Revenue times 1 minus T plus depreciation time. So this way is, FIN 404, we use this way, just practically solving the problem. So revenue times 1 minus T plus depreciation times T. If you use this way, if you use this way, then what? This one is also same as 380 times 1 minus 380,000. 380K times 1 minus 0.35 plus minus 400 minus 490 0.90061 times 0.35. There is this. Check the number. No more fun. So time to have quiz. So I'll cover more. I'll continue next class. So the password is 946. Oh, not this one. Okay.